Okay, welcome everybody to our Investor Club for February. My name is Emily Cortright. I am your KW Wealth Ambassador. And what that means is I am part of the KW Wealth Mastermind that meets in Phoenix 3 times a year. And part of my role is I take what I learn at the masterminds and I bring it back to our market centers. And one of the ways we do that is by hosting investor clubs. And one of the topics that we talk about a lot at KW Wealth is passive investing, because a lot of us have very busy lives, very busy businesses, and one of the opportunities to invest in great assets with great returns is by doing it as a group passively. And so I have, Mr. Billy Glass was referred to me by Barbara Pantuso, who is in our office, and he came very highly recommended. So we always want to bring in speakers and syndicators, people who put together deals that have been very, very highly recommended. And so Mr. Glass was one of those people. And I am really excited to learn about hotel investments and hotel syndications, because that's not something I've ever invested in personally. So I'm really excited for today's class. And I would like you all to help me welcome Mr. Billy Glass.
Thanks, Emily. Bring that chair. Thank you. Gosh, what an honor it is to be here. I appreciate y'all wanting to know about what we do. I remember I was trying to explain to my dad what I did. My dad passed away about 3 years ago, and I don't think my mother and dad ever really understood what I did, but that's okay. We're in the commercial real estate business, so a lot of things most people don't understand. Before I get started, I just wanted to say I do a very relaxed presentation. I'd rather it be conversational as opposed to me just talking at y'all. And so if you ever have a question, just stop me, and I'd be happy to answer it. So I'm not really a great presenter. However, I'm pretty good, pretty fair conversationalist. So let's just have a conversation, you and I, and talk about, a little bit about something that sort of evolved over time for me. Scott, my partner, Scott Palmer, who's here with me today, also Ashley Baird, who's head of marketing and communication. So anything that comes out of our office, probably Ashley wrote it completely or partially. But Scott and I started working, and I love the setting here of Keller Williams, because it reminds me of when Scott and I started out years ago at Hank Dickerson Company. And many of you may have I don't know if you've heard of that, but when we came up in the business, there were two companies. There was Henry S. Miller and Hank Dickerson Company. Scott got there a little bit earlier. I think you got there in 77, didn't you? Or 76? 77. And so when I got there in 81, he was an old pro, and he was sort of showing me the ropes. But we became friends then, and have really basically stayed friends this whole time. And when I started in the business, and Scott, you comment here wherever you want to, but it was like I was a 250-pound cocktail waitress. I mean, there were so many transactions going on that it was really hard not to be able to sell commercial real estate. And we would have 4 or 5, maybe even 6 or 7 transactions going on at any one given time. And that kept us very busy. But then you remember what happened, if those of you that were in the business at that time, 82 got tough. And, 83 was tougher. And then you had, of course, the savings and loan debacle, and sort of everybody that had a line of credit in Dallas from commercial real estate, everybody, because the FDIC came in and said, you're all over line. So we all had to go move our loans or pay our loans off or what have you. So it was a very, very difficult time. And then, of course, what happened after that, let me just go back, though. When we started to have some difficult times, we were out doing our research, and Hank used to say, you got to be known for what you know. So you have to have an area of Dallas that you're an expert in, and you have to know every ownership. That's back when we'd go to the courthouse and dig up all the records. Now, of course, you can get it online, so it's sort of laughable now how much easier it is. But so we would have properties, but we'd show them to people, and they weren't buying. And so Mr. Dickerson, we were sitting there going, Hank, we've shown this to 5 or 6 people, and we don't have anybody that's interested in this deal. And he said, well, we need to buy it. And that intrigued me. I said, Mr. Dickerson, how are we going to do that? I don't have any money. You know, I barely pay for my house. But I can tell you stories about Hank that were unbelievable. The faith that he had in guys like Scott and I, and some of the things he did as far as just having faith in the young men that work there. And I don't know if you know all the people that came out of the Hank Dickerson organization, all the commercial real estate folks. I mean, Scott, well, we had Bill Dufall, you know, obviously he started there, and he's the head of Lincoln Properties. The Ulicks that ran Vantage, Charlie Adams. I mean, I could just go down a who's who list of people that started out at the same time Scott and I did. And, you know, Hank trained them all. And so it was sort of amazing. So when Hank said, well, we need to buy that deal, that sort of triggered this thought in my mind, well, how do you do that? And Hank said, well, look, just follow what I do. I'm going to show you how to do it. We put together a Texas limited partnership. It was the first time I'd ever seen a partnership document. And he said, look, I'll tell you who to call on. Just do this and this and this and this. We'd run around town and we'd call them as individuals, and we'd get partners. You know, we were raising $1 or $2 million on a piece we were doing land. It was just land, raw land. And so a lot of times in those days, we would get people to carry the note. So let's just say it was a 20% down payment. We'd raise the 20% downstroke, and, you know, just we'd put the program together. Then we would own it and manage it and try to sell it for a higher price later on. But that was the first exposure that I got to syndication. I thought I knew everything that there was to know in 1983, and so I left Hank and started putting together partnerships on my own, and I put together about 60 land partnerships. And unfortunately, I sort of looked in areas that, like south of town around the superconducting super collider. I don't know if you know all that about that, what happened down in Ellis County, because I was from that part of Dallas, and that sort of had mixed results. I packaged it all together and sold it in '86, right when Graham Rudman hit, and it gave me enough money to get through '87 and '88 and get into '89 before the market really started turning around again. That's a little bit about my background. Scott was with Mr. Dickerson, as I said, from 1977. You want to talk about that for a little bit?
Well, I started with Hank, very fortunate to be there, and I worked with Hank. I was a broker for 8 years, and then Hank and I formed a partnership, and we started buying entrepreneurial investments around the country, and I continued doing that until things got really rough, so that was in '85. And in '89, things got really rough, and he asked me to handle his financial affairs. He had loans, development loans, land loans, and I handled all that for him, which was a tremendous privilege and also a great experience. It taught me a lot about banks and how they operate and how to deal with them. And I continued on, and I stayed with Hank. He and I were partners until his death in 1996. I went there was another Dickerson guy named Dean McFarland, who had a company that was just they were doing one-off acquisitions, and he asked me to come and help him, and we bought some office buildings, and I did some entrepreneurial investments there with him. And then in 2006, Billy was at McFarland too. Billy came over there and he raised a bunch. Billy is a great money raiser. That's what he does. And he was raising money for McFarland. I was doing entrepreneurial investments. And then Dean decided he wanted to change, and he didn't want to use that source of money. He wanted to go the pension fund route. And he wanted to change my compensation, Billy's compensation. We said, no, thanks. We're still great friends, but we went and formed Gentry Mills Capital at that time. That brings us. We started that. We've done how many offerings?
We've done 42, and we've had, 22 go, 42, we've had 21 or 22? 21 go full cycle. And so everybody know what full cycle means. We actually sold the asset, distributed the funds, and, made a return. And this track record shows you every deal that we've done, and from soup to nuts from the beginning to the end, except for the last 4 properties that we just sold because we closed on them like 8-9 days ago. Yeah. So those aren't on here. But just to back up a little bit, thank you, Scott.
Did you have a question? Oh, I thought you raised your hand. I'm sorry.
So, the question was that Mr. Dickinson said, don't worry about the money, But I found out very quickly that, when you're raising money and you run around town and that's all you do 100% of the time, as opposed, after you find the asset, you run through your friends and family really quick. So I'd go to my dad. He said, well, I'm not going to do a deal, I'm not going to invest any more money. So I very quickly understood that I was going to have to go to a different source and a larger source. So my kids were playing baseball with just playing baseball, and one of the dads was standing around out there, and I said, well, what do you do for a living? He said, well, I work for a broker-dealer. And so, and y'all know what a broker-dealer is in the stocks and in the financial services industry. Well, if you don't, you need to sort of think about it. Broker-dealers basically sell anything that's a stock, bond, mutual fund, investment vehicle are sold through what's called a broker-dealer, okay? So does anybody know what an example of a wirehouse is? Morgan Stanley. So that's up here at the top. There's like 6 wirehouses. Then you have a second layer below that that's called regionals. There's about 20 regionals. Guess how many independent broker-dealers there are? Let's take a guess.
No.
Sir?
1,000.
That's 1,000. About 6,000. So, what happens is that if the people that work for those firms, they're trained at the Morgan Stanley level. But as they get experience, they go down to the regionals or to the independents. And the reason for that is the commission, they pay more commission. At a wirehouse, you might get 30% of the amount of the commission. At a regional, you can get up to 50. At an independent, you can get up to 90 commission. So experience starts up here. They get their experience at the Morgan Stanley level, and they work their way down as they gather their own clients, and they move down to get the higher breakout. Now, some of them want to stay at Morgan Stanley. I always laugh, and they say, why are we like being at Morgan Stanley because all the support that we get from the home office, they pay for our office, but also the bad part is that Morgan Stanley owns your clients. They actually own them, okay? So if you leave with 0, okay? And independents and regionals and independents don't do that. Didn't mean to digress in the securities world, but I wanted to tell you about that because you can only raise money, and Emily, you've probably encountered this. I mean, who will we call on? You can call on a lot of people, a lot of high net worth individuals. But then, when you go to a broker-dealer, that broker-dealer may have 200 advisors, and each advisor might have 200 clients. So you can go and make a presentation like in a room like this and have 20 advisors, and they represent, 5 or 6, maybe even 1,000 clients. So you can really cast a wider net.
So in 2008, we agreed to provide the equity for the Embassy Suites in downtown Houston. And that's when the world was beginning to fall apart, the financial crisis. We thought we were going to get an 85% loan. We ended up getting a 60% loan. So Billy he raised $26 million in 2009 in that one transaction. Take a guess. Somebody take a guess. Like Price is Right. What is the average investment for $26 million for all the investors that we went out and raised that $26 million? What do you think the average investment was? Get the $50,000? That's a pretty good guess.
Pretty good guess.
It was $22,000, which means it's a massive.
He was really.
He worked really hard in the midst of the world was collapsing, but it's a massive market.
Yeah. So when you think about every stock, bond, mutual fund, insurance product that's sold through a broker dealer, I mean, it's just a gigantic marketplace. And a minute ago, Scott said that our friend Dean McFarland, who we both worked for a while, he wanted to go, and he told us, he said, well, I want to go to a source to raise money that is bigger. Well, there is no bigger source. I mean, you think of Merrill Lynch or you think of Morgan Stanley. I mean, there's no bigger source. I mean, of the people that raise capital for, investments. And so I understood what he really meant. What he really meant is I don't want to deal with all those little investors. I want to deal with one big one, and I can have one decision maker and get my money, sort of an easy way to go. And everybody wants that. But unfortunately for me, I always had to deal with a whole lot of people just because I like raising money, I like eating, and I like being able to get my deal closed. So anyway, to go back a little bit more, Scott was working with Mr. Dickerson. I left in 83 and I started syndicating raw land deals, and I did that for a period of time until 86, and I sold that to a public company, those 60 syndications. And then I went to work with a group. Have you ever heard of Watson and Taylor? Watson and Taylor was a big mini storage facility, a company here in Dallas. And one of the principals, Tracy Taylor, started buying notes from the FDIC, RTC and the FDIC. And I don't know if you remember those days, but they would sell, you'd go into a room like this and there'd be banker boxes everywhere in the rooms. And you'd go in there and they were loans from banks. Anyway, we bought a bunch of those, which is one of the most amazing things I've ever seen that has happened in my time in the business world. But we did that. I did that for 5 years, and then I went to work for ING, just as what they call a wholesaler, working in the securities industry, raising capital, for a big international company. That was really difficult, and there was just travel. I traveled all the time, and then I was lucky enough to get to work for Dean McFarland, our friend from Hank Dickerson Company, and I raised money for them and Scott's acquisition. Scott was on the investment committee there, and he identified properties, and I raised capital for them. And as he said, just to bring it all together, we both left in 2006 and formed this company, Gentry Mills Capital. So we're a family-owned and operated company. It's Scott and I and about 8 other people, and Ashley, and 9 total folks. And we just are a small company. We're really focused on just purchasing limited service Marriott and Hilton hotels. Does everybody know what I was talking to this gentleman right here about limited service? Does everybody know what limited service hotels are?
Like extended stays and stuff like that.
Ma'am?
Like an extended stay.
Yeah, extended stay, like Town Place Suites.
And maybe a full like restaurant.
Yeah, it doesn't have a full service kitchen, bar, and room service. But a lot of our properties have a bar. A lot of our properties, we serve breakfast, but it doesn't have all that together. Yeah. So like a Town Place Suites, like a Spring Hill Suites, Courtyard by Marriott, Hampton Inns. We have a lot of Hampton Inns, Hilton Garden Inns. But that's the types of properties that we purchase. Now we're going to talk a little bit more about just sort of some specifics, and as I said, if I can figure this thing out, these are some of the properties that we've purchased. This property on the left there is a property that we own in Jacksonville, which is the Hampton Inn Homewood Suites. It's sort of cool because one building, two hotels in that one building. The one to the right there is the Homewood Suites that you can see right there. And then a Courtyard there, that's another property that we have. I've talked about our background, but Scott, do you want to talk about this acquisition and due diligence? Because you can look at it here if you want to look at it that way. Okay.
What we do is we constantly source our deals from brokers, we do management companies, from developers, from in some occasions from the actual brand, and we focus on Hilton and Marriott only. We own a couple of high properties, but we make a decision we're just not going to build them Marriott. They are the 2 800-pound gorillas. Everyone else, it's a big drop off in the reservation system. So what we do is when we go out, we find a deal. We'll negotiate the best terms we can. We'll evaluate the historical performance. We select a management company, and we negotiate a new management agreement. We secure the debt. We get a new franchise. You have to get a new franchise agreement from the brand. And then we get third-party reports, which is our due diligence, which tells us that there's no environmental issues and property condition. and then, we close it. We have an asset manager.
Will he be speaking?
Independent asset manager that takes care of all of our property.
But the same. Thank you, sir. Sure.
And that's really it. Asset management is, they make the decisions, or they help us. They make recommendations to us as to when we should refinance. They oversee the general manager and the director of sales at the hotel, and then they also, we all come together and we decide when it's time to sell or it's time to refinance. So that's basically what we do on the acquisitions front.
I have a question.
Sure.
So go through your due diligence. I think that's the property for me that I have an opportunity to buy. Then I noticed here that you have some of these turn pretty quickly. I mean, like 2.5 years and some are 5 years. What's kind of the litmus test for you guys as far as when you're going to pull the trigger?
What we do when we can maximize our investment.
Yeah.
So here's the thing: we model it. All of our models are 5-year holds.
Okay.
But we tell our investors we expect a 3 to 5 year hold. So now COVID disrupted that, because we have, if you see on there, there's a number of assets on there that we've owned for 7-8 years, because right when we were getting ready to settle, a lot of these assets in COVID hit, and with the hospitality industry, it was rough. But I will say this: it recovered a whole lot faster than what we expected to. Everyone thought it was going to be, 24 before we got back to 2019 numbers. And by the end of 2022, we were back. So it was bad, but it recovered quickly.
Okay, so that makes sense. So you basically say, I'm familiar with the multifamily. You have a target that you're looking to hit. You think you could get there in 5 years, but if it happens sooner, you make a decision whether or not you want to pull the trigger sooner than
Right.
Okay.
Whenever we think whenever we can make the right, what we think are good returns for our investors, is when we sell. And if something happens, or it could be we'll see something. I'll give you an example. We owned a hotel outside of Denver, and it was doing really well, but we learned that there was going to be a big tax evaluation.
Yeah, increase.
And it was going to, taxes were going to go up significantly. Well, that cut out potentially $1 million out of our sales. So we went ahead and sold it before that reevaluation from the tax.
We're really pragmatic. I mean, we're value guys, so we're always looking at the price that we buy it per room, but we're pragmatic in the sense that we're not going to pass up a profit. If we think it's a good profit that our investors need to take, we take it. And so it's pretty simple decision. Along the way, the asset management part of it, making the correct decisions to take care of the property, to move the right people into the right slot, get the right people in the right place on the bus, that's difficult. Sorry, Scott.
Another question? Yes.
For the property management, is that in-house? Is it third party? Is it location specific? Like, do you have different property management companies, different markets?
Yes.
Mm-hmm.
It's all third party.
Mm-hmm.
And we have multiple property managers. We'd say we have 4.
Yeah, 4 or 5.
And there's, we have, I'd say 5.
When you invest through, go ahead, I'm sorry.
Oh, I was just going to ask, so I assume since you have the entire, U.S., have you found challenges in specific markets that you no longer want to deal with, or have you found better markets that perform?
We try to go to markets that are stable and that are not overheated. Like, for example, Florida got really overheated a couple of years ago. Well, there's a number of challenges that you want to look at. Like for me, I personally I want to steer clear of coastal areas because the insurance is so, and it's not just the premiums. It's if you have there's something called a named storm.
Mm-hmm.
And if it's a named storm, forget about your deductible.
Yeah.
Instead of a $25,000 deductible, it may be 3% of the asset value. So if it's a $20 million hotel, you know, it's a big number. And so we watch that very carefully. We also, you know, there's states that we avoid, like we're not big on Louisiana. We're not big on Illinois. Well, that's because Louisiana has its own set of problems, but Illinois' property taxes are just terrible. So, and also we look at it, if it's unstable, like San Francisco, we wouldn't do anything in San Francisco right now. You know, just, but we've
done things in California, but San Francisco,
we've gone from
Portland,
from
Seattle,
from Long Island all the way to California. So we've owned them all the way across the country. We haven't done anything outside the continental United States.
What's your sweet spot in the country?
Well, we own a lot of assets in the Northeast.
Mm-hmm.
We own 4 assets in Texas. But other than that, it's pretty. That's the concentration. We have 3 in Florida.
We just sold 4 in,
which is still, you know, that was really, you know, it makes you nervous.
I understand.
Yeah. But, you know, Scott is, you know, paid to be a nervous person.
I'm sorry?
Do you have any specific reason for selecting Marriott or Hilton?
Yeah, it's in New York.
No, Marriott or Hilton.
Oh, yes. What was it?
He specific.
Yeah, they're the best. They're the best.
It's the reservation system.
What do you have? Pull your wallet out.
Okay.
Do you have a Marriott? I bet you have a Marriott or Hilton loyalty card. Do you? You do?
I didn't get you.
Okay. What do you, in your wallet, do you go to Marriott? Do you have a Bonvoy card or a Hilton Honors? You probably have both of them. Okay. I bet everybody in this room probably has both. Okay. That's why the reservation system is, you know, is the best. Okay. So that's the reason.
Okay, thank
Yes.
How about the play, you know, the investors wanna, you know, invest these, you know, deals? Do you guys have any specific targets for the play?
Yes. Well, you got to remember, we put together what's called a Reg 506C offering that is a exemption under the SEC's, the rules for putting together offerings. And so we were in the 506C. So if we have a foreign national that wants to invest, they have to have a U.S. Social Security number, and then we have to withhold for them. Okay, so that because that's just the rules that we have to operate under. But yes, we have some foreign, very few. We probably have, 8, and we have to withhold for them.
You have to be accredited.
And then, everybody has to be accredited. You know, under 506C, everybody has to be accredited, and there's specific accreditation rules that you have to adhere to. And we could talk about that if you want to get into that.
Hey guys, I looked at your list. I've actually stayed at some of these places.
Really?
Probably.
And I go like, oh my gosh. Yeah, when I used to travel, I mean, the one in Cortright,
Yeah.
I stayed there.
Yeah.
Exactly where it is.
Yeah. We just sold that last week.
That's it, just
Yeah.
We sold, we had a courtyard, but then we built the Homewood Suites in the same, they
next to it.
basically shared the same parking lot. Right there in Ronkonkoma. We sold both those assets as well as a Hampton Inn a few miles down the road. So we sold 3 of our Long Island assets.
You go down the Long Island Expressway, another mile, and it's right there.
No.
exactly where it is.
Yeah.
So when you syndicate, the other thing that I'll tell you, there's a lot of tax advantages that I'm sure that your clients will want. These hotels just throw off tons of depreciation. We do a cost segregation study on each property that we purchase to maximize depreciation. How much detail do y'all want me to get into that? Are y'all interested in that?
It's the right tax opportunity.
Yeah, it's just basically, when we buy an asset and we renovate it, with 100%, the old rules of 100%. I mean, if you invest $100,000, you can probably get a $90,000 write-off in the first year. So we have a lot of people that follow us just for the depreciation. And of course, depreciation is great for wealthy people because why? Anybody would tell me?
Tax shield.
Okay, how does it work?
I think it reduces your adjusted gross income.
off other passive investments. It's not your regular, like salary. It's off of your passive income. So it's passive against passive, okay, which is wonderful. And then on top of that, what happens when we sell? You have to recapture, but what do you recapture? If let's say you have $100,000 piece that you invested, okay, and you sell it after 3 years, and you've written off say you write off $100,000, okay, what do you recapture? What's the amount that you recapture? It's 25% of whatever you claimed. So if you use that depreciation, you write off 25. You took the write off. You have to recapture 25%, which to me is a whole lot better than paying 39.5% on my ordinary, passive income. So we have a lot of people that follow us just for that. So that's a great thing. That's what we do on every property, cost segregation study. Now, cost segregation study, let's talk about that quickly. Cost segregation study goes in and it takes all the furniture, fixtures, and equipment, and they put all those items on a short depreciation schedule. So they would say this table can be depreciated over 4 years. That computer can be depreciated over 6 years. And the accountants set those up on depreciation. Now, a hotel has beds and sheets and all sorts of things that you can depreciate, so it's just, and it generates more because Scott will tell you that we hold 4% of our gross revenues for what we call FF&E reserve. And that reserve is going to do what? It's going to buy more stuff to put in the hotel that's also depreciable. So it just is sort of a never-ending cycle of depreciation, and then as you spend more money, you get to depreciate that, write that off. There's all sorts of tax strategies in the financial services world that people love. One of the big raging things that's going on right now is the Roth conversion. And I don't know if y'all have ever looked at that. Y'all heard that?
It always talks a little bit about.
It's a pretty cool deal because we have to set what's called an ERISA evaluation on our hotels, so that if somebody invests in a qualified plan, like a qualified plan, qualified money. So it's not just money that's in their checking account; it's money that's in their qualified plan, their IRA, 401k, what have you. And they have a custodian. And the custodian requires for us to put up an ERISA evaluation. And a ERISA evaluation is how we value that asset, okay? And I won't get into that. It's not that difficult, but we set the ERISA evaluation. We've always done it one way, and it's just the existing appraisal against debt leaves you the equity. And you divide that between the number of investors that you have, percentage-wise. So let's just say, for example, you invest $25,000 and your ERISA valuation for some reason is $20,000, okay? That's fine, but there's not much discount. You invest 20, or you invest 25 and you have an evaluation of 20. But when we remodel hotels, what happens is on that appraisal, there's 3 values, okay? As is, okay, and then there's going to be improved and as stabilized, 3 values. So let's just say that one, the first one is very low because it needs to be, like, for example, we just did a deal in in Colorado Springs, and we bought it, what was it, 18 million? And we put in another 12, or was it 10? About 10. So when you look at the appraisal, the value was like $18,000. Okay, but we had to go out and raise $12 million, okay, because you had the loan, okay, and then you had the improvements. All right, so what happened is that value, that ERISA valuation is like $18,000, okay, which meant that it was like, and the loan was, okay, the first appraisal was $18 million and the loan was $18 million, which means that your ERISA valuation is very low.
Yeah.
So then what people would do is they would buy the investment with us. They would take dollars from their regular IRA, okay, and they would take it from there and convert it to buy a Roth, invest the money through the Roth, okay, and then when the following years when the value goes up, it goes from very low valuation on the ERISA to what they invested, Now, what have they accomplished? Emily knows. They've accomplished basically taking something from a taxable entity, traditional Roth, to a non-taxable entity, a traditional IRA to a Roth, okay? So you have avoided tax on $100,000. Now, I'll just be honest with you, I don't advise people to do that. But if the advisors want to do it, the people that I work with in the securities industry, broker-dealer firms, if they want to advise their client to do that, good for them. However, I think that, all these tax strategies, you leave yourself open to some, the IRS to look at those things. However, we've never had anybody look at that and never ever even had one question. So a lot of people are doing it with little consequence. Did you have something you want to say, guys?
That move around.
Okay. So anyway, yes, ma'am.
Sir, so my family has a share in a Best Western.
Yeah.
We've struggled with Best Western just to keep that, name brand gets to decide anytime when we need to upgrade this and this and this. And so it can kind of go at their whim, and like you lose your status as a Best Western if you don't do exactly. Do you find that as a struggle to like keep the Hefton name brand or Best?
Oh, Scott and I have some pretty specific views on that. I mean, we like Marriott and Hilton telling us what we have to do to the property because they're pretty lenient. Like when we went through COVID, we had some properties that were really struggling, okay? And there was work that had to be done on those properties, and Marriott and Hilton said, look, don't do it now. Do it when we get through COVID, and you can do the improvements later on. And, we had some of our loans that were, we were in forbearance. A lot of the lenders realized, hey, we're at 5% occupancy. This customer cannot pay us on this loan because they have no occupancy. And so they were very good to us and very lenient upon us and allowed us to push those improvements off. Okay. But then when it all changed, when we came out of COVID, then they wanted, for you to do all the improvements. And so it was difficult. But Marriott's always been pretty reasonable. So is Hilton.
But to answer your question, it's what they call a PIP. It's a property improvement program. And and it just depends on how long you're in it. Generally it's a 7-year PIP. So every 7 years there has to be a refresh of the hotel in its entirety. Now throughout that 7-year period, they'll come in and they had inspections where the quality control inspections, and they'll come in and they'll say, hey, this or that needs to be done, or you got to change out this. You have to change out this television technology, the streaming and all that. And so they can do that in between the 7 years. But the 7 years is when you actually have to do the entire hotel. And then also when you buy a hotel, they have what's called a change of ownership PIP. And that is when we buy a hotel, we know that when we get our new franchise agreement, there'll be stipulations that we have to do a certain amount of work within a certain amount of time. So I think that's what you're referring to. And it's just one of the necessary evils.
It's like a 4-letter word to my dad.
Yeah.
3 letters of fiscal letter.
Well, it's not usually a small bill. It's usually a large bill, and it takes a lot of time. And also you displace your customers. So when you're doing that work, you displace people and you can't keep your rooms occupied. So it's something to really consider.
So is that something like you said that you're studying the conditions? Are you getting like a PIP assessment?
Yeah, we have to have before we buy anything, we have a PIP from the flag that tells us what we have to do, and then we go and price it.
That's part of the franchise agreement.
Yep.
Right. On this particular asset that we're showing today, it was built. It's new, and so right now we're not facing a PIP for the next couple of years.
We'll get into that in a little bit, but let me see. I guess of course you have to get your accounting group in early. Okay, so if you're going to do this business, be involved in this business, I think the worst thing you can do is have your limited partners wait on their K-1s. Because you know how it is. I mean, everybody wants to get their K-1, before they file April 15th. Well, accounting people, CPAs, unless you train them, will make you late every time. Not sometimes, every time. Okay, every time. And this is something that when I was working for other people, because I worked for other people for 25 years before I started this company, they didn't listen, and I didn't have the control of the company where I could force them. Okay, my deal now is that they have to have our K1s out by the end of March, so that I can get those to our limited partners by the first day of April. That gives them time to go to their CPA firm and get their taxes filed on time. So I would just suggest that you make that a big priority in your businesses.
So you're telling me every property you have or every limited partnership, you're going to pay on by March 31st?
Yes. We've never been late in 20 years. Because why? It's tax preparation. You start early. Okay, guys, I know you want to do my tax work, but if you want to keep the business, you have to have my returns done to where I can have those K1s ready to go by the end of March. If you don't, then I move. There's a question over here.
Oh, like
Somebody.
So when do you close your books?
Well, you close your books at the end of the year.
I don't. I'm just saying, are your books closed by the end of January so you can?
Well, here's the deal. Okay, I'm just going to tell you. Everybody says, Billy, you can't demand, because we do distributions on the 15th day following the end of the quarter. But everybody says, well, we can't get that done because March books aren't closed till, what do they say, April 20th. The 20 days beyond the end of the next month. And I said, no, you have two months that are actuals and you project one month so that you can get the K1s out on time and the financials out on time. So it's just something that when I worked for larger companies, they did this routinely because you can't be late on that reporting.
Estimates.
They're estimates. 2 months are actuals, 1 month's an estimate, you know? Anyway, you can really make a lot of people very angry. So if I have an advisor and he has 50 customers that's in my program, he has 50 people yelling at him. I have him yelling at me, but he's my customer, okay? Not his investors. He's my customer, so I've got to take care of him. Anyway, so let me see what else. Where are we going to go now? Why limited service? Scott's already talked about this a lot. Do you have anything else you want to talk about limited service?
It's more efficient. It's a more efficient hotel. The extended stay and limited service are just more efficient, and it's a good model for us. The only exception to that is we didn't buy Embassy. We built the Embassy Suites in downtown Houston. But we also bought the Embassy Suites in Colorado Springs. But Embassy Suites is kind of a hybrid. It's not. It is a full service hotel because it has ballrooms and it has a bar and all that. But it's not what we avoid is the massive boxes, the big boxes that are really inefficient. So we stick to limited service and extended stay.
What's that?
It's in bed.
Yeah.
So
Yeah, we want heads and beds, but there's a fight between occupancy and rate, and I'll take rate any day over occupancy. Because if you have a property that's 95% full all the time and you don't get the rate, you're going to wear your property out. I'll take 75% occupancy at a very high rate, because I get more money and I don't wear my property out. So that's a thing that Scott and I talk about all the time.
Is expensive revenue.
Yeah.
Just like the other thing that's expensive revenue is all these outlets where you can go online like Expedia. Okay, Expedia is great for you to get a good rate, but that hotelier is dying when he sells that business through Expedia because he had to pay he has to pay a commission on every one of those pieces of business that come through. He pays a commission. All right, so I don't want to get into, limited service hotel have, and Ashley, you want to talk about this slide for us because you worked hard on it.
we're going to switch the microphone.
No, that's okay.
She wants us to. That's not a request.
You can hear me, right? Do you want to hear me? Okay.
No,
As long as it's video.
Come over here. Come here.
It's just a metric basically that demonstrates that we don't have all extended stay hotels. They're all limited and select service, but some of them are extended stay hotels. And this is just a metric done by CBRE that talks about the extended stay segment outperforming other segments in hotels, the ones that offer breakfast. On a good amount of our hotels offer free breakfast, meaning that it's an important amenity to folks that are seeking hotels. And that's one of the things we specialize in. So
Great job, Lee. Way to go. Ashley's background, she was in politics before she joined us, and so she can talk. Anyway, why Gentry Mills? We're going to talk about the current offering we have right now, and we've talked about the number of programs. We've done 42 programs, 21 have gone full cycle. We've raised quite a bit of money. Not much for firms that are in, you talk about a REIT. I mean, they raise $2 billion per offering. So we're small. We do one offering, one partnership, one property. So anytime you invest with us, it's going to point you to one property, in a specific location that you can go and look at and kick the bricks and sticks. Josh is not here today, my son. He's the VP with our firm. I've talked about these things that we're family owned and operated, and we have a commitment to integrity. You're not going to have to be looking for us to ask us questions. We're going to be right in front of you all the time. We report quarterly and monthly. And like tax time comes around, we want to get you your tax information on time. It goes into your portal, and it's in your portal. So if you're an investor, it's sitting in your portal. If you're an advisor, it's sitting in your portal for your client. And so are all the financials. I think I've talked about most of those. Let's talk about this particular property. Since y'all live right here, we have a property down at Esther's in 114. It's Town Place Suites. And you can see, what is the name of that road? Is it Corporate? I want to say it's Corporate. Plaza, that's right. Anyway, it's back over behind, if you get off on Esther's, it's back right up next to the airport. And this is 100.
I could be a lot skate upstairs.
Yeah, say it again. Yeah, that's right. Yeah, exactly. You want to give some background about it? You want to talk about this a little bit? I can talk about it. Go ahead. Yeah, so this is a property that we built back in 2017. We built it and then opened it right before COVID.
We opened it in 2019.
It was like September of 19. We opened it right before COVID struck. 2-3 months. It was doing really good, and so and then it didn't. So we had a partner that was our development partner that built this property, and so we were watching it, but we had this gentleman that was also built it and was watching it. And I noticed that the rate was getting up higher and higher because he had refinanced a construction loan with a loan that was not fixed. So the rate got up pretty high, and I said, look, we've got to take this loan. It was a construction loan for $15 million. So I went and got a local bank right here. As a matter of fact, just a bank that y'all right over here, and they loaned us $10 million. But I had a $15 million loan. And so I had to go to our original partners and said to them, guys, this is not going to work. We can't pay. The interest rate had gone up to 12%. I said, we can't pay 12% on $15 million. So you're going to have to allow me to restructure this transaction and lower the debt from 15 to 10. This is, it's a classic delevering of a property. So we went from
very contrarian in the real estate business. Everybody wants leverage. We want cash flow. We want to be able to distribute. So we bit the bullet, and lowered our debt from 15 to 10, which generated cash flow that we can pay to our investors. And so it's contrarian, but we think it's the right move.
So how did we do it? Because we have a $15 million loan. We replaced it with a 10. We had $5 million delta. What did we do? Well, we went out and raised that money. Okay, so we raised it with limited partners. And so we're nearly through this offering, but we've effectively delevered the property. And now the people that are in it that chose to invest in this, their basis is very low because their basis is the new, is derived from the new structure, the $10 million in debt and the $8 million that we raised, okay? So I'll show you the capital stack that will help you look at this. So you can see here, the new senior debt is $10 million, okay? The investors that are preferred investors have their $8.1 million in that next block, okay? And then what has to happen is the new investors, and I'm going to give you a spreadsheet on this, and I'll give you this deck if you want it. But the new investors have to get their money out, the money they invested, and a 15% annualized rate of return, and then whatever's left over, and that's all they can get, and whatever's left over goes to the original $6 million that originally put their money in when we built the property. And so you come out with, really, and I'll show you this basis graph. You can see right here that the all-in cost is $18 million, which is, I guess, $151,000 a key. And you couldn't build a property now for $250. If you could find a piece of property over there at DFW. Of course, we're right there with the new terminal that's over there. Terminal E, is that what it is? Terminal E. They spent $1.8 billion on the thing, and then they've spent another $7 billion on DFW refurbishing it. So we think that, and DFW is the second busiest airport in the United States. And it's really just very, very busy. So anyway, at any rate, you have a low basis in it, and we think it's a pretty safe transaction as it goes in the commercial real estate business. You know where this is located. This is two pictures. You can see the semicircles there above, and then this is an aerial shot looking down on all the semicircles that are at DFW Airport. It's the third largest in the world, second busiest in the world, which is amazing. This talks about the Dallas-Fort Worth area, which y'all know all about. Y'all sell it every day. You can see what we did here. We delevered and structured fixed lower rate. We changed out the property management company. And we didn't ever build a property management firm. When you invest with some hospitality companies, you're going to always have one property management company, which is owned by the syndicator. Okay. And I don't like that model, because what we do is we sort of hire best of class in an area where we are in the country. And tell them this is Scott's brainchild. He came up with a structure where they basically got a 2.5% property management fee. And then if they hit budget, they get a bonus. Okay. But if they don't hit the 2.5%, if they don't hit their budget, then we change. And all the property management firms out there know we'll do that. So they know going into the deal the way we think about it. So, but if you go to any big REIT or any big hospitality firm like us, they're going to have their own property management company, which is them. So you'll never get another shot at it. It's just the way it is.
It seems when you talk about growing the contracts and top accounts and things like that, is that something that the property management company does, or is that something your company
Both.
does on your own?
Property management company does. You'll have your hierarchy in a hotel. You have a general manager, and really the director of sales is the next most important. You'll have an assistant manager, but really the second most first, and I would say almost equally important would be the director of sales. And he or she is out there beating the pavement, get contract business. That's their job, and it's very important.
Yeah. And like any property that we have, you can say, Billy, give me the list of your top corporate customers, and we'll give that to you. Because we are business, we look for business in our hotels. We look for businesses to patronize our properties. It's not just, parties and weekend events and stuff like that.
You don't want to depend on highway business, people, billboard business. You want base business that fills the goal is to build a base amount of business, so that kind of supports the hotel. And then your transient business that comes in, you drive higher rates because you have this base down to the safety net with this base business. Then you can drive higher rates, and that's where your profits are.
This just sort of shows you the way that the business has increased over you said, Scott, over the last few years. You can see what happened in COVID. The net operating income was $550, and then it went to $894, and then $969, and then we just finished this past year at $1,226,000, and I think we're budgeted for $1,400,000, Scott, $1,400,000 in the coming year. So this is it.
On that previous slide, how have you reduced your expenses, your turnover expenses 10%?
great question. This makes me so happy to talk about it. It makes me so happy to talk about this because we looked at that as low-hanging fruit. And what happened is our previous partner that was in there had one management company in there, and I won't tell you who it is, but they were, when a guest would leave the room, we have to make it up and get it ready for the next guest. They were charging about $36 to do that turnover.
39.
Okay, thanks. He gets all flossed up about it. Yeah.
That's way above that's out of market. And that's why we said we have to change this management company because their costs were and we expect that number to go down. We still have when we changed the management company, there were some transition costs. And so that $36 number really needs to be down lower in the low 30s. And so it had crept up year over year. And we finally said, guys, that's enough. That's it. We're done. And
they do that because your meal cost, like, I don't know what your cost, your laundry costs or housekeeper costs, from that, all that should either be the same or be going up. You would say, I was thinking.
Oh, how did we get it to go down? Well, because it was fat. Shouldn't
have been there. We have properties that we have
a huge deal is that we're now going to share a van with the
Homewood Suites.
The same company that we hired, and that's Texas Western. They also manage the
Homewood Suites.
Homewood Suites just down the road, and so we're going to have a joint van, and so we share that cost as well as the employee the driver cost.
It stuck out to us though because we have properties that we operate where we're at $23 for the turnover.
Mm-hmm. But that's in a different. It's, for example, that he's right in that is down in Portland, Texas, and the employment. Yeah, that's outside of Corpus Christi, and the employment, Dallas is more expensive. So we don't expect it to be 23, but we do expect it to be in the low 30s. And every dollar it goes down, that's times the rooms that are sold for the year, and that's about 300. See, how many rooms?
I remember
38,000, I think, something like that, times every dollar that you save. So when you go down from 36 to 34, you're saving $70,000 a year in the cost, and so it's means.
That's takes the bottom line.
That's exactly right. Yeah.
What's your sweet spot delivery doors as these? So
most of these select service hotels are in the 110 to 130 range.
We have 150.
We've had some as high. Well, the Embassy Suites was 262. That's the biggest hotel we've ever owned. But I'd say the average is about 125.
This property is 119. There's one here in Irving. We're buying one at Granbury that's 106. So we just are contracted for the Courtyard by Marriott in Granbury. Hilton Garden in Granbury that's connected to the convention center. So you may have
up there overlooking the lake. It's really we're looking forward to that.
Anyway, we've had some nice increases on the revenue and NOI and at this property, so we're excited about that. But anyway, this is a little report, and I'll be done. It's a little report that we send out monthly that shows on every property that we have. We list every property and what the monthly revenue, sort of the occupancy and rate is, and then some special things that are going on within the company, and that's chopped off at the top, so it doesn't give you the full size of the report. And then we do every quarter we come out with a full quarterly report that has a lot more information.
Yes.
So I think it was 1 year and said you sold for a loss. But, in the last 2 years, there have been a lot of syndicators that basically suspended their distribution properties they invested in. Have you guys had to go to that as well because of interest rates?
Well, interest rates and COVID, the combination, there have been some assets that have not distributed in a couple of years. That just is what it is.
COVID was terrible, but these interest rates going from 4 to 8 was devastating.
But let me explain why. The reason why it's devastating is if you had a 5-year loan that was originated in 2018, it came due in 2023, or maybe it's 23, 24. Well, those interest rates, that interest rate that we originated was probably 4.25%. Now it's 8 or right around 8%. Well, what does that do? There's covenants within your loan documents that say you have to have a certain amount of debt service coverage ratio. And if you don't have, or
debt yield,
but primarily it's debt service coverage ratio. And if you don't have that, you're going to be in default. So what you have to do is you have to bring new equity into it to bridge that gap to meet those covenants. So it's the interest rate is a bigger deal for us as it relates to the
cash flow,
the refinancing assets than COVID was.
But we're very fortunate in the sense that, you know, we've done very well even in light of that. So, I mean, I'd say it's devastating. And Scott and I have been in the business for a long time, you know, and it's just we've sort of learned to avoid the pitfalls. You know, we haven't been completely devoid of them. I mean, we've had to stop distributions on some of the properties. But if you ever see, you know, something's going on in our company, you're going to get a straight answer. We're not going to dance around.
You can't foresee a pandemic, right? It is what it is. And then the interest rates, again, it's just one of those things you're going to have to manage around. Yes.
I see that the current offering, it has a 15% preferred rate of return. And that's kind of unique because it's restructuring the debt. When you have a new offering, what is a typical structure?
8.
Or it's 8.
It's 8. It's an 8 preferred rate, rate of 8% preferred, and
we shoot for an overall return. And when we model these, you know, look at an investment, we shoot for on a stabilized asset, not new development, but a stabilized asset. We shoot for a return somewhere in the low teens, 12, 13, 14% overall, including all distributions and sale proceeds. That's what we shoot for. So, but you get 8% prep
along the way. So you get that every quarter. We pay 8% annually, paid every quarter, so 2% per quarter. And then when we sell, we catch you up. You see what I'm saying? To the profit. You know, if there is a profit, right? I mean, it's commercial real estate business. You can sell it and say, well, you got a 7, you know, and so, but if you don't make distributions, you might get something like that. But by and large, if you look at our track record, you know, pre-COVID, we were mid-teens on nearly every return, you know. So that's just the way we structured it. But right here, the thing that you see right here, if you look down there, it says operating net cash flow on the hotel is 6 to 8% in 25. Okay, next year we think we're going to be a little higher than that, 8 to 10. But you know, we just want you to be very clear. It's not 15%. You know, paid annually. It's 15% at the end of the day.
Annualized.
Right.
Annualized. And so and what that means is what Billy alluded to earlier. So you've got that original equity piece that they are new investors in this preferred equity. They're ahead of the old investors. The old investors don't get anything until new investors get, at the end of the day, a 15% annualized return.
And the return of their capital.
And the return of capital.
Right.
And then, but then you're capped at that point, and then the old investors kick in.
Are your old investors being taken care of more than the 13%?
No, they had them into this. Oh, absolutely. They had every single investor had an opportunity to come in on it's a secondary offering. So they had the opportunity. Some did, some didn't. But the ones who did not are going to be behind this new equity. And everyone understands that. There's a whole another PPM. Everyone gets it. And they have their chances. But that's what makes this offer so attractive, because your actual basis is that $6 million doesn't count of the old equity. It's just the new equity is what your basis, the new investors, that's their base.
So anyway, you know, you can see the appraisal. We had to get a loan. When we got this $10 million loan, the property appraised for $170,000 a key, and that was $20 million. What was it, Scott? $20,300,000 when we got this new loan just a few months ago. So, well, we appreciate y'all's time. I don't want to take too much of your time. We appreciate your time and your patience and your questions. And, you know, anything else?
Any other questions? What kind of upturn are you looking at right now? It's a 5-year, and what kind of need?
What kind of leverage?
Yeah, are you
Well, this is the one where we have $10 million of leverage on it. Is that your fixed? It is
Fixed at 8%.
For
5 years, 2 years,
5-year term.
2 years interest only.
And so some of these older assets you have that, were like 6 and 7 years. Yeah, some are 16, 17, a lot of 17 to 18. Have you had to refinance those, or is it original loans, or
Oh, we've refinanced most all of them. So that's, we're actively involved in refinancing these properties because, every time we can get a little bit lower rate, if, we're going to try to get that because that increases our cash flow. But we're careful about that. We like to refinance with the same lender so that we don't have to pay points or as heavy a points, but we're constantly trying to manage those loans. Yeah, it takes active management. The deal is these are not on autopilot. You're passive. The investors that come into with us, they're passive. They just get their K1 and get their cash flow. Scott and I, like a swan. You're nice and smooth and beautiful on top and pedaling like hello,
I wanted to say, what's the financing environment like for hospitality rent?
It's improving. It was, a couple of years ago, it was a little I would say the word was toxic, because that's what we would hear. But we still got some
great.
We got some loans, but it was a struggle. It's a lot more. We're getting good, much better debt today. We had on this deal we're going to buy in Granbury, we had 3 banks competing for it.
I want to, if you can pass me the microphone, I want to give one to the any experience.
Thank you.
So just to kind of loop back on the bonus depreciation conversation, I want to give a quick testimonial because the bonus depreciation is so important. And so back in 2018, I sold 3 rental properties that year. Let's just say we made $100,000 on each because they all went up in value. I owned them for 6-7 years. And instead of having to do a 1031 exchange, I invested in a syndication in the same year that threw off a lot of bonus depreciation. And so instead of having to go through the 1031 and the rules and everything, if you invest in something in the same calendar year, and you can utilize that bonus depreciation to offset other passive income. Now, it does have to be passive. Now, selling my rental properties was passive. So that is a way where if your client comes to you and says, I want to sell something and I'm going to have all this taxes that I'm going to owe, you may want to consider, having them consider a syndication that's going to give a lot of bonus depreciation in the same calendar year. I also got a text from an agent just last week, and she said her client is going through a 1031 and he only has 20 days left to identify 3 properties. And I'm like, well, was the property sold in 2025 or 2024? Because we're talking about 2 different issues. She said it was sold in 2025. Well, that's a lot better problem because if that person can't identify something for a 1031, now you have the rest of the year where they could invest in something, whether it's a hotel syndication, whether it's another type of syndication, something that throws off a lot of bonus depreciation, and you can essentially offset or kick the tax can down the road for that, assuming it was passive income. So I just wanted to kind of give that example because it's a really, really important topic when you are selling assets. How do you avoid the capital gains taxes? Well, you avoid it by getting bonus depreciation on the next purchase. So that's that's a strategy we've utilized for the last 6 or 7 years to minimize our taxes. Oh yeah, and instead of a 45-day clock, you have an entire calendar year. You have January to December 31st. So I just wanted to give that example.
Great job, Emily. She is a good teacher, I'll tell you. I mean, y'all are very fortunate to have somebody that understands tax.
Thank you for your time.
Appreciate it. Thank you.
Everyone.
Going back.